just told Mitch, I mean, if he would just get a little bit of energy, then it would really take it over the top. Hey, got a laugh out there. All right. Yeah. Okay, remember, hashtag NoteExpo. Keep putting it up there. I noticed a few of you did that. Larry, not to point out anybody, but good job. All right. Okay, so our last session of the day is going to talk about some capital markets. And we usually wrap up day one with this panel. And I've got a couple new guys on it this year. So I'm going to ask my panelists to come up here. We had a conference call about a week ago to kind of talk through, hey, what do you think people be interested in hearing? So we got some discussion points. So I'm going to let these guys come up here, grab a chair, and then we're going to hear from each one of them. And then I'm going to give them some good talking points. And we're going to wrap up this session for day one with giving you what we have done so far this year, what we think is coming down the pike in 2019. All of us run various forms of capital funds, so we're going to hear from different perspectives, and I'm looking forward to it. So, Bill, I'm going to start with you, and if you'll introduce yourself, and then we'll go right down the line.
Welcome to the Happy Hour panel. My name is Bill Bymel. I am the managing director at Spurs Capital. I'm also founder of a company called RSI Asset Management. I've been in the note space since 2008. Lucky timing, I guess. RSI was a company I founded to do valuation and loss mitigation, due diligence, and advisement to private funds. Spurs Capital is a private fund manager. We've been responsible for about $750 million of NPLs that we've purchased over the last 10 years, and mostly with a focus on judicial states like New York and Florida.
Good afternoon. My name is Cody Fowler. The business is Fowler Financial, and based out of Tucson, Arizona. And the company was started in 2011 as a loan sale advisory and has since developed into both an advisory and a principal acquisition firm for various types of notes. Done business with everybody on the panel here, including Bob, and happy to be here and share some knowledge and gain some knowledge.
My name is Louis Amai with NS Capital Management. We are, I would call it a mid-sized fund. We have an asset management platform, and we acquire both NPL and REO in all 50 states. And we also have our internal REO platform, and we've developed some unique acquisition channels.
Good afternoon. My name is Fuquan Bilal, CEO of Energy Capital Fund from the Garden State of New Jersey. I run a fund. We invest in real estate, real property in 5 counties in our area. We're in New Jersey. We're the #1 foreclosure state. I know you guys don't like judicial states, but we love it. It's plenty of inventory. We also invest in mortgage notes, first and seconds.
Outstanding. And on this panel today, my role, in addition to the moderator, will be as the fund manager for Colonial Impact Fund, so I'll share where we come from that perspective. So, Fuquan, since you have the microphone here closest to me, why don't we start with you? And just give us a brief recap on what you thought the first 10 months of 2018 has been for you before we start looking ahead to 2019. What have you seen going on in the market?
Yeah, it's been an exciting space for us, with the new opportunity zones that we're gearing up to take advantage of to get those tax benefits out there. We have plenty of those in the areas where we're investing in.
That's an interesting. Go ahead and explain a little bit about the opportunity zones to make sure the audience understands what you're
So these are blighted areas. You may want to check it to see if they are in your state where you get tax benefits. This long holding period to give investors opportunities to invest in the fund and get those tax benefits. And it's an area. It's an opportunity for funds to revitalize areas. I just got Invisalign, so to revitalize areas in the community. So that was one of my passions for real estate, was because I'm from Newark, New Jersey. It's an area where there's a lot of dilapidated properties, and one of the things I wanted to do to add to the community was to revitalize those properties, and that was one of the reasons I got involved in real estate. So this is a great play for those of you who are looking to add value to those communities. Also, give a tax benefit to investors that are investing with you for the long haul, and make a great deal of money. So it's been a great trying to set up the fund and gear the fund towards that opportunity, because I think in November, sometime at the end of this month, they sign off on it for New Jersey, so that'll be official. Also, with the notes, we've seen a lot of opportunities. I know a lot of people come to me and said they're not seeing opportunities with notes, but there's still plenty of opportunities that are out there just depend on which you're buying within your wheelhouse, whether it's judicial, non-judicial, equity, what the CLTV is if you're investing in seconds. There's still a lot of opportunity out there, so we're seeing, an abundance of deal flow. So it's been great for us.
Outstanding.
The interesting thing about these opportunities, and it's ironic because we're not yet involved in opportunity zones, but I think it's a brilliant opportunity, and that's perfect for the name. For those of you that don't know what this is, it's like a 1031 on steroids with a lot less limitations. Does everyone understand the 1031 exchange world? This opportunity zone legislation was part of the 2017 tax bill. And what it did was it allowed the states to identify these neighborhoods like Fuquan was mentioning, but they're doing it by census tract. So there's actually some decent areas that are getting designated as opportunity zones because they sit on the edge of blighted areas. And if you are an investor that has a capital gain this year, you should look for an opportunity zone. And I'm not talking a real estate capital gain. I'm talking any type of capital gain. If you're ready to sell Amazon stock and get out of the market, do it this year and look for an opportunity zone because you can now defer all of that capital gain, long-term or short-term capital gain, for up to 10 years and maybe beyond. The IRS is still working on all the details of this, but at least half of the states in the US have identified these census tracts. And I know for one in Florida, we've got waterfront property that's sitting in an opportunity zone in West Palm Beach right now.
Yeah, so just to recap the question, 2018, the first part of the year. I think Fowler Financial has seen, a very diverse set of opportunities. Ranging from bank failures from '07 that we're still working through the system and consisted of out of statute opportunities that very few people could understand. And so I think therein lies the opportunity many times. There were some changes with, Georgia licensing was certainly getting stricter and cracking down. So we saw opportunities from folks saying, hey, we only have a few loans. It doesn't make sense for us to go through the licensing process. We need to sell these. So you saw some shifts of product that were event driven. Same with Maryland. A lot of folks with Maryland started to say, hey, we can't foreclose now because you need a collector's license, et cetera. And so those were opportunities where if you had your finger on the pulse of the market, you were then able to capitalize. I think for us, because if you think about a filter on what your buy box is, we really don't have one. And that helps us tremendously because whether it's a first lien or second lien, whether it's mortgage or even consumer, or it's high value, low value, performing, non-performing, reperforming, we're in there. It's contract for deed, mobile home. So the spectrum of loans that we can deal with, that's very much in our favor. So my suggestion is do what makes sense for you and your proficiency with notes and for your capital situation. But if you can be very specialized but still adaptable, a niche is great. But when things change, you need to be able to change with it. And so I think we've done that, and we expect to do more of the same in 2019. It'll be business as usual.
Great. Lewis?
As far as our business, we launched in 2014 in conjunction with a nonprofit entity to specifically take advantage of whom we thought were going to be the biggest sellers in the marketplace for the next several years with the GSEs and HUD. So that niche, as Cody put, has been worked very well for us. So we've seen continued negotiated acquisition flow for the past couple, 2-3 years. So we're able to close anywhere from $3 to $5 million a month through negotiated trades. That being said, that niche is starting to dry up this last quarter. So we are working on several different solutions, expanding our different type of acquisition channels, and also thinking about getting in some type of lending through a CDFI and taking advantage of the opportunity zones that everybody is also discussing. So I think remaining flexible, but also having a niche where it's kind of difficult for others to come in and compete against you is critical. I think in today's world, if you're able to drive the deals opportunity, the cash will come as far as your capital raise. Whereas previously during the crash, deals were so plentiful that cash was king. I think those who can develop the deal flow in today's world is in the driver's seat.
Expand just a little bit on the nonprofit piece, because I know we've talked several times over the past few years about your fund and how it's structured and kind of the commitment you make to homeowner retention when you buy these loans. I always thought that was an important piece, not only financially, but obviously for the social impact it has on those neighborhoods. So if you can kind of just expound on that a little bit.
Sure. It took us about a year and a half, but we got approved by HUD to be a neighborhood stabilizing outcome that participated in their NSO auctions that they've been doing since 2012. So every trade we do, the sellers are able to get certain HUD credits towards these NSO outcomes. And so every trade is approved by HUD. So we go through a transfer request, what's called a transfer request package, and we explain to HUD how we're going to manage this particular trade. And our objective is basically two things, homeowner preservation or affordable housing. So we work through the assets, and we have our nonprofit partner do an outreach and door knocks to create alternative loss mitigation opportunities to keep the homeowner in. If the homeowner is unable to stay in, we move the asset through the foreclosure process, and we do a lot of rehab and sell to first-time homeowners, or at least an owner-occupant. What we found in the last year, we do a lot of rehabs, mostly in New Jersey. We have about 70% of our portfolio in New Jersey. We have, at any given time, 50 to 60, top-to-bottom rehabs going on. And the real estate prices have been doing very well, so that's really worked out for us.
Louis, do you think the fact that you were a nonprofit involved in this NSO, did that help you with the price you were paying for notes along the way, or was it still an auction process where highest and best wins?
So that's a great question. So the Fannie, Freddie, and HUD auctions, even though there's nonprofit slice outs or NSO auctions, those still price pretty high. Where we found our niche to be was the retrade. The retrade for that NSO buyer to get a HUD credit. So we get negotiated trades incoming monthly from all the buyers who purchase NSO auctions.
Yeah, that's interesting. And he's mentioned negotiated trades a few times, and I'm trying to, for those that don't know the industry lingo, a negotiated trade is when you have a seller and a buyer, or a seller and maybe one or two or three buyers. So it's like, as a buyer, you want to go into negotiated trades because you don't have as much competition with other buyers. Whereas the government sales are all auction format. So you have to do a lot of times you have to do your due diligence up front. So there's a huge expense and a risk that you might end up with nothing. Negotiated trades are obviously the preference. So that actually you make a very good point there. You've got guys that are going out buying a couple $100 million from HUD with a promise to do some good things for neighborhoods, and they figure out they can't do what they've promised to do, so they come and sell you the note at a further discount and try to make their money elsewhere.
Right, so selling to us gives them that HUD credit towards the 50%. Early on, we saw a better discount to the market price for the NSO credit, but primarily the opportunity is consistent negotiated trades with a smaller discount.
So, Bill, do you want to answer the initial question about how 2018 has been?
Yeah, so we, exactly. We have always done business with our competitors in the industry, and usually it's like the guys that are a step above, right? The guys like the Pimcos, the Pennymacs, the Angelo Gordon, Newburger Berman, Carrington, Bayview, guys that are buying thousands of loans at a time. And the guys that are asset managers or sit on the capital markets desks at those large organizations, every once in a while they come to an end of a tranche, or they have some kind of bond redemption that they've got to raise some money for. So we have a pretty consistent flow based on our secondary mortgage market contacts to bid stuff in a negotiated basis on a regular basis. You hear a lot of people that are coming into the business wanting to buy smaller quantities or trying to develop connections, complaining about the difficulty to find product these days. And that's been true. It was a lot easier 5 years ago when banks were just throwing loans away, basically. And I guess this is what separates the men from the boys, so to speak. And look, but it's not the wrong time to be prepping for the next cycle. We all know that the market operates in cycles. So we haven't done as much in the first part of this year, but we're starting to see a lot more now. I think there's a little concern amongst some as to the frothiness of the real estate market, the slowing down in sales, and even some downturn in values. So we actually just launched a new fund, and we're hoping the fourth quarter will be a big buying opportunity for us.
Yeah, I think traditionally the fourth quarter is always an exciting time, right? Because there's certain banks, certain entities trying to get stuff off their books, rebalance their portfolio. There's folks sitting on capital, trying to spend their capital before the end of the year. And now this year, I think we have a tide coming next week with the elections that nobody really knows what's going to happen until that's over, especially as it pertains to, say, interest rates. I don't know if any of you guys have any leverage on your funds. We don't at Colonial have any leverage, but if interest rates increase, that could affect that. If you have leverage, how are you preparing? And if you don't, how do you think that may affect those that do have leverage, where they're borrowing for some of their capital, and that cost of funds could get pushed up?
Yeah, we're not leveraged. Oh, well, that's not, one of our funds does have a little bit of leverage, but primarily we're all equity, we're all cash in all of our investments. So, but we see the opportunity. We're already starting to get, it plays into that sense of what I just mentioned, that we're seeing some edge amongst those that do have, especially a higher leverage amount, and maybe looking down the pipe at higher interest rates. So that's just an opportunity for us.
Because they'll be looking to move some inventory.
Exactly.
So yeah, we're not leveraged, and we don't plan to be. I mean, a lot of that trigger UBITs for certain IRA people. So, our model is diversify hybrid real estate investing, and it goes back to some of the stuff you guys spoke about, being able to take advantage of whatever opportunity come if it's a shift in the market, whether it is increase in the real REO inventory or having the opportunity to buy first, seconds, performing, non-performing. So we've changed the parameters of our fund to be diversified. So that's what we focus on. So if there is something that happens in the marketplace where there's a market reset with pricing, with notes or real estate, we can take advantage of whatever opportunities are out there with the diversified approach.
This may be a little variant of an answer to the question, but with respect not so much to the capital, but how some of these effects might influence the way you look at the business. I saw a lot of folks looking for underwater loans and RPL in particular when we started to see a lift in home prices. I mean, it was dramatic. I mean, a lot of folks, this market was clearly coming up. Would you want to buy, if we did have softening in the market, would you want to buy underwater NPL, where you're going to have to factor in some home price depreciation potentially into your modeling? You can adjust for it, but if you're on the conservative side and you want to shift towards higher equity, lower LTV loans because you think that there's a softening in the market just for downside protection, that's the first thing that comes to mind for me when you think about uncertainty around rates and the market.
That's a very good point, Cody. Our newest fund partner actually specifically wanted us to target equity loans as opposed to underwater loans for our first trade recently because of that concern. Smart guys. Not me.
Currently, we don't use any leverage, but I could see how the increase in interest rates could potentially provide some unique buying opportunities for those that are trying to liquidate off those higher interest rate debts as they start to increase. One of the things what I'm really focused on as far as looking in towards the futures is really looking at some of the trends that we're seeing as far as growth in GDP and household wealth. The first sign that household wealth may be outpacing GDP at too quick of a rate is an increase in interest rates as the Fed starts to tampen that down. So there's certainly some concern, I believe, surrounding the fact that there could be a slowing in the marketplace, but that creates just other opportunities. So that's the key to this, is not to get scared about a certain moving trend, is to really figure out what's going to work in that particular trend going forward.
All right, so in that vein, are there any other opportunities or new avenues of business that you guys are looking at maybe expanding into in 2019?
We are looking at creating a CDFI in California. So I'm based in San Diego, California. All the NPL and REO we purchase is east of the Mississippi, mostly in the Northeast, Midwest, and some of the Southeast. So in San Diego, in California, we've seen equity prices dramatically increase in the home value appreciation. Interest rates are at 2%. So we're looking at creating a CDFI to target certain specific MSAs and income levels to do second mortgage lending. To get it back into the origination space, which I was formerly in a few years back. We think there's quite a bit of opportunity there. And the other area we're looking is the opportunity zones. I think that's going to be a big deal over the next 2 or 3 years.
I agree with the opportunity zones. I like CDFIs because I just like doing good things for communities and stuff. But the area that I'm most interested in keeping an eye on next year is commercial real estate. Notice that we had this huge crash in the residential market, and yes, we had some distress in commercial loans and commercial real estate, but it really did not suffer a major downturn the way some were predicting. And what could have been the cause for that, I believe, was these unusually low interest rates we've had for a decade. And you see that. I remember in commercial pre-recession in 2006, for those of you that are commercial real estate investors, or 1031 buyers, you get the whole cap rate thing. And they would go for retail, like you'd have investors coming in, and I thought it was a little strange even to see a CVS trading at a 6.25 back in 05, 6.25 cap return. I thought that was a little pricey back then because I grew up in the 80s, so it's like, my father was happy when he came home and got an 11% interest rate on our house. So I think there's something going to happen there. I think that you're going to see, especially with the ever-changing face of retail, we're going to see shopping malls and suburbs shutting down and repositioning. I've got a mall in South Miami in Southland that just went in, not my mall, but there is a mall in South Miami that just went into special servicing on a $75 million loan. It has a Macy's and a Sears. I mean, of course, they're having some troubles. And the other thing that I looked at is, I mentioned the CVSs were trading at a 6 cap in 05. CVSs are trading at a 5 cap now. Wawas are trading at 4.75. I mean, who wants to buy a gas station that's going to end up having environmental issues at a 4.5, 4.75% return? That market is disjointed. And as interest rates rise, I think those that have leverage on commercial properties are going to see a lot more distress. You're going to see some opportunities in that arena, in my opinion.
Yeah, I don't think I've got a particular investment class or loan type that I'm necessarily targeting differently. We're definitely more in the seller finance space, whereas I was really more on the institutional paper side of the business for a long time, and now we do both, so there's some diversification there. But I think what I'm going to do more of is just have an eye towards collaborations. I think we've done a good job of that, but not a great job. And I've just seen the fruits of those collaborations, over the last 6 to 9 months. And so part of it is the marketing effort, getting out, asking the right questions, and I think just honing our skills even more. Because I've had some conversations with a number of folks in the room. You could be at this business for decades, and each deal is different. It may look like one of these, but you learn something new. So I think we're going to do a better job of just sharpening our skill sets and preparing for what's to come.
Yeah, just a little color on that. I mean, in the role that Cody plays on some of the trades as the advisory, he may have a large trade, and it may end up where the rest of us all take a piece of it. And he's kind of like the coordinator. Right? He knows, hey, I got to have a super high price on that, and Bill overpays, so we'll put Bill on that. And then, Lewis has got his niche in certain MSA areas, and then Fuquan wants this area, and then Bob will take, whatever's left because, he has no parameters. But that's the part that I like, and I agree with the collaboration right now. in Bill's case, he's obviously the biggest one of us up here as far as capital, and he goes, I wasn't going to say that. But he goes and he's able to deploy a lot of capital at one time. And the rest of us are kind of like strategic with it. And if I can do a deal with Lewis and Fuquana, we could pool our stuff and he can get what he wants and he can get what he wants and I can. I think there's a play for that down the road, right? And instead of looking for a retrade, it gets retraded, it gets retraded, and all of a sudden I'm the third guy down. Well, it's been discounted 3 times, right? So
it's a good point.
I'm looking forward to more
And
of that.
it enables you an opportunity to group pricing while specializing, right? So if you're new to the business, especially, I would advise not just buying any loan in any place that you can. Try to pick a location that you know, or maybe it's close to home or whatever. Focus on something. And so in that example, that allows when you joint venture, we do that even in the $100 million level. JP Morgan approached our trader to co-bid the New York portion of something they were looking at from one of the government agencies, So it certainly is valuable to do joint ventures like that.
Fuquana, any new opportunities?
I'm going to stalk this guy for some of that New Jersey inventory. No, we had a great conversation the other day about the opportunities that he has available on the REO side in New Jersey. So we're looking to ramp up that portfolio. We're changing the strategy a little bit more on the luxury restorations. My realtor told me don't say flips, say restorations, the type of quality work we do. But we are lowering the price point on the acquisitions as far as what we're targeting. The resale of our luxury REOs were $1 million, somewhere between $850,000 and $1 million. Now we're lowering that down to $400,000 to maybe $600,000 so we can touch the millennials and make it more affordable and be able to turn the product over, because the absorption rate and days in the market, all that is changing for that type of product. So we're focusing more on ramping up that REO portfolio, doing some restorations. So that's what the focus is on in 2019. We have collaborations with a bunch of people where we do sidecars and joint ventures on trade. So we're always looking for more opportunities and meeting more sellers. So that's pretty much the focus on 2019.
Good. So we kind of talked about interest rates going up. We talked a little bit about maybe values getting a little bit pushed down. We all know history tends to repeat itself. And one thing I've noticed, I've had some conversations today, it's like, oh, we're getting back in subprime. We're going to get back in some of this non-QM. And I'm like, all right, we're not that far removed from the last time we all tried this, right? And everybody says, well, now it's different. We're going to be a little more careful. But we get right back to you're sitting on capital. You want to get it deployed. You start loosening up the bucket a little bit. You guys see a repeat of some of the stuff we had before as more and more subprime and non-conventional type product is originated?
Well, I certainly am seeing a lot of subprime come in my inbox. I can't believe it's back. It's not being done as much on the institutional level. Obviously, it's more private equity that's funding a lot of it. So maybe they're doing it smarter. Who knows? I am a big believer in market cycles, and it feels very 2007-ish to me right now. That said, we're not going to the Black Swan event's not going to be the fall of Lehman Brothers this time. It's going to be something else. It could be geopolitical. It could be student loan debt. There's obviously a lot of elephants in the room always, right? And this is the nature of markets. I promise a crisis is coming, and you just have to be at the right place, right time. So I haven't seen any of this new stuff, that the non-QM stuff that's defaulting at high rates or anything. So we're not seeing indications of that yet. But again, it's early. Low interest rates have been able to hide a lot of our mistakes for years.
Very good. Okay, so we come across a lot of people, they get in the note business, they buy a few notes, they start their portfolio, and then they're like, I want to start a fund, right? I want to be a fund manager. Well, we've got some fund managers up here, right? Is there a lot of fun in fund managers? Okay, just saying. So we all have different sizes, right? Some got big teams, some have small teams, some do a lot of outsourcing. Let's talk a little bit of just philosophy as far as starting a fund, having a fund? How do you manage your expenses? What's your strategy? Fukan, let's start with you.
Sure. A fund is like having kids, actually.
Love it.
Because, yeah, for me it was, something I wanted to do to be able to take advantage of bigger opportunities out there. I've been in real estate since 99, 2000, and I always had private investors. So people set up funds for different reasons. They want to get better price point. They want to be able to pull the trigger on trades when they have the opportunity instead of trying to leverage individual IRA accounts. There's a lot of different reasons people set up a fund. It's a lot of work. It's a whole different business, raising capital, something that you learn over the years, putting yourself in the right place at the right time with the right people. It's a full-time, day in, day out, 7 days a week. You're responsible for other people's retirements and everything else. So you have to make sure that you execute, you underwrite the deals properly, and you always keep that investor in mind. So I would say for those of you who are just getting started in a business and maybe you have some real estate experience and you've been doing that for a while and now you're ready to transition into a fund, just look at, what's involved, get a hold of a great SEC attorney, meet with people who are actually running funds to figure out, what's the challenges they're facing, the growth period that they go through and, the challenges, because I don't like to use the word stressful because you learn from the challenges you go through, and adversity always brings growth, but people always think the grass is green on the other side. I mean, there's a lot of great opportunity for you to make money as a Class A member, depending on how your fund is structured, but it's a lot of work. So we don't really have any equity participation. A lot of people are like, oh, I want a pref plus equity. We don't have any of that because of the work that's involved to run a fund. So, a lot of funds are set up different, but yeah, it's definitely like having kids.
My experience, I have a little bit of a different background. I came from the institutional side. So from 2000, 2006, I was at GMAC RFC, and I was a seller. So I was running a group called the Servicing Capital Group. It was basically trying to figure out ways to reduce our severity, because we weren't trying to make money in selling our loans. We were trying to reduce our loss because the market started to crash. So when I left, I was selling about 60 to 70 million a month in NPLs and redemption paper. The reason why I left is because the guys at the trade desk in Minneapolis who were acquiring all this stuff didn't care that we were losing the money on the background. Their answer was really, we're making so much money on origination of stuff, we can eat all the losses on the back end. So GMAC, back then, smartest guys in the room, we're going to hit a brick wall. So I left and I started a fund called National Asset Direct, and I deployed probably $300 to $400 million between 2006 and 2011. And that was a crazy experience because we grew literally from 2 people to about 250 people. We built a servicing platform, RE platform. We had offices in San Diego, Dallas, New York. That was a crazy period. And so when I left that platform to start this platform, and we were really going to focus on the nonprofit and be a niche player, did it completely different. Kept it small, kept it niche-y, and build something that you can run and be profitable and have a good lifestyle without basically killing yourself. Because you're right, being a fund manager is extremely stressful because you have expectations from your investors, your operators, you're supporting your employees, you raise the money and it's all about, you got to spend the money, and then the next thing you hear is, but don't spend too much, right? So it's like you're balancing this thing that kind of drives you crazy. So this go around, I really concentrated on keeping it small, keeping it niche-y, super low overhead, just to stay really skinny, to be able to become a niche player and take advantage of the opportunities when they arise, but not feel the pressure to buy every single deal that comes your way.
Yeah, so I probably have a little different perspective than the rest of the panel, in that we have intentionally not formed a fund despite available capital and available resources around us to form it. Lewis made a great point just about expectations. And for me, I've just made the choice that the only person's expectations I really want to exceed are mine and my family's and my loved ones and the clients that I serve in an advisory capacity. And we've done very well working with other groups that where we are the, I'll call it the who, that simplifies and solves for the complexity of the advisory piece. Now, you just need to decide if you do an inventory of all the activities that you do today in your business or that you would do if you had a fund, you've got to just ask yourself, are those things that I want to do? And if the answer is yes, then great. I think you go and you form the company. And for me, there are just other priorities. I think that when you say, if I say yes to this, what am I saying no to? I ask myself that every day. I mean, it's a question daily in the morning. If I say yes to this, what am I saying no to? And for me, I feel like I'm making the right choices about the crucial results that I'm targeting each day because I find them fulfilling. It's my unique ability. And working with folks in the capacity that I do today really does it for me. So if that changes, then I'll change the business. But it works so far.
Thank you. I like listening to you talk. You're so good. I know that sounds weird, right? I didn't mean to sound that way. Anyways, so there's whether to start a fund and then how to administer a fund. And my experience has been sub 20 million, it's very difficult to have enough of a management fee to really cover the personnel and support staff that you need to really do the job correctly. I only know this because I've done friends and family funds for 1 million and 3 million, and I'm usually coming out of pocket myself to administer that. And the other issue is, why are you starting a fund? With the question of whether to start a fund, where are you getting your money from? Do you know you have investors that are willing to be passive fund investors? I have learned the hard way that it's not that easy to raise money. And especially because all of you sitting in this room are here because most of you want to be active in the note space. So if I'm talking to a room full of active investors, it's hard to then convert those people into passive fund investors. I spent 2 years trying to raise capital, and I thought going into it was going to be a piece of cake because we had, at that point, $600 million of track record at a 15% annualized return without any leverage. So I thought, well, everybody's going to give me money, right? It's a no-brainer. But it's not that easy. Identifying people that want to be a passive investor, you got to ask that question before you think about starting a fund. Some of you may have passive investors that want to back you. And a fund would work very well for that. There's a lot of benefits to being in a fund. As a loan buyer or as any kind of distressed real estate buyer, you have to have access to your capital very quickly. You have to be able to make decisions, sometimes on the fly, about whether to execute a trade. If you're talking to a loan trader at another big fund and you are negotiating a trade with them, you don't want to then turn around and say, okay, now I got to go back to my investment partner to get approval. So there's benefits to having the fund. But again, from our perspective, we didn't want to launch our newest fund until we were at the $20 million mark, and that's just knowing what kind of resources in terms of fund administration, the costs of overhead. It's obviously a lot of upfront costs to do a fund correctly. You're talking a minimum of $20,000 to $50,000 just in legal paperwork and compliance. You've got to hire third-party administrators, auditors to do it correctly. And you can do some of this, obviously, with friends and family without that. And as far as the administration of a fund, if you decide to go that route, my one recommendation is to stay top light, right? Don't go out and overstaff. So many of our competitors in this business came and went over the last decade, I think because they got real top heavy. They started to staff up. And they went from a 5-person fund to 250 employees And when the business, there's a lot of forcing of, when Lewis said, that you have funds in a fund, you feel forced to spend it because you're paying pref to your investors even while it's sitting there. So there's a lot of factors to take into consideration. Don't overspend on human capital too much, because you've got to go through the ups and downs of the business. Over the years, we've been successful, but there's been years that we haven't done a lot of business over this last 10 years. So by staying vendor-oriented, top light, not a lot of salaries, we've been able to manage through those times where there was less gross income coming through the door.
Yeah, and I want to piggyback on the first thing that when Fuquan was talking about raising capital, a full-time job, there's a lot of full-time jobs being a fund manager, right? I mean, it's hard to raise capital and be the operator of the fund and be the fund manager and spending the money. So at Colonial, we're fortunate enough where we have a dedicated person, Ryan, who's raising the money, and I'm managing the fund, and Eddie's out there chasing deals and working on downstream exit strategies and liquidations and things like that. So we've kind of channeled it out. But if you're starting a small fund and you got to wear all three hats, then that's where mistakes get made.
Right.
You make a bad buy. I mean, we are under stress sometimes. Like you said, we're sitting on capital. You want to spend it. You got to pay a pref. Well, the only way you're going to spend it is by overpaying for a deal you don't want to buy.
Right.
So we've got to stay disciplined to our pricing model, and sometimes that means you lose a deal by a point or two. Right, and we've all had that happen. We've all had that happen recently, right? So, I mean, and you put a lot of work. Fortunately, you don't have to spend a lot of money most of the time on due diligence unless you have the deal locked up. Right. But you spend a lot of time pricing and doing a deal, and then all of a sudden it's like working on that deal forever, and it didn't happen, But I think it's better to either redeem the capital and give it back, or pay the pref than making a bad buy and just saying, well, I don't have any more, I spent all my capital, because I think in the long run, that'll come back and bite you, and you're going to have unhappy investors.
Right. I mean, this is, Neuberger Berman's exiting the NPL space, and they're one of the largest holders of NPL in America privately right now. And they've figured out that they can't figure it out, and so, it is obviously a very intricate business, and I think the problem that they had was they allocated $1 billion to the strategy, and so they ended up exactly in that situation where they had to put capital out, and then they ended up overpaying for some of those HUD trades, and I mean, it's like, 80 to 100% of BPO that they were paying on average a few years ago, so.
All right, so we got just a few minutes left. I want to go around real quick. We've got an audience here. Some have been in the business for many years. Some of them are relatively new. I want you to give 30 seconds to a minute of just advice heading into the next year. Just from your position, you got an audience out here. Here's your, they're going to come back next year.
Right.
And they're going to go, Bill, you told me that, and it really resonated. Right?
My advice is read my book.
Oh, yeah, here we go. We're going to start. Let me just be on the record here. We have two acclaimed authors on stage. Fuquan has a book. Bill has a book. Lewis, Cody, and myself are all going to work on one together so we can compete with these guys.
I brought a couple with me that I've left at Cody's booth. So visit the Faller Financial booth. I've also left a few at the AHP Servicing booth. For those of you that can pick it up, it's also available on Amazon. But the message is actually in the title, The Win-Win Revolution. I heard this gentleman before us talking about making sure everyone wins. That's very much our paradigm in this business. Now, we only buy first lien mortgages, so I have it easy. I know that the borrower or title holder is always going to have to come to me. There's very little opportunity. I'm going to lose my investment. But that said, I still look my quote-unquote enemy in the eye and look for a solution that's a win-win. I know from having mitigated $250 million worth of loans personally, that's over 1,000 loans in 10 years, that my best resolutions always came when I found a way to give the borrower what they want. Maybe not everything they want, obviously. Most of them want free houses. But find some way to give them what they want. Create a win-win resolution, and that's the best strategy for success in this business.
Yeah, there's a book by Harvey Mackay called Dig Your Well Before You're Thirsty. And the concept being develop the relationships kind of before you really need them. And I think that if you do that, you'll be well positioned in the business. The other two things I'd say are be a great problem solver. Bill's point about finding that win-win is part of that. But it's also really being excellent and world-class at your craft and being able to, when somebody tells you no, say, well, what about this? And you approach it a little differently. I just had a banker the other night. We made an offer on a non-performing loan, and it wasn't quite where he needed to be. And I said, well, what other assets do you have on the books that you can allocate when we buy those across, and then we'll make this happen? And he didn't have the other assets. He did, after I said that, say, well, you're going to be my guy moving forward when we have those. And we ended up putting this deal under contract. But I think thinking a little differently, being a great problem solver, I think that advice is probably applicable to everything, but definitely in the note business. And then thirdly is just the follow-up piece. That so many deals happen because of the follow-up, and some of it is timing, some of it is showing that you're persistent and you're gonna be there with a long view, for the relationship. But I just see so many times, and I've been guilty of it myself. I'll go to a conference, I'll have a lot of discussions. Maybe you take notes, maybe you don't. We just don't remember things. And so I think being really diligent about the follow-up, and maybe it's saying, hey, I promised you this. How often do we hear that? Hey, I'll send this to you. It doesn't happen. And that's really where, that's part of the relationship with Bob. We just have, when we say we're going to do something, we do it. And that's a big point about referability, is do what you say you're going to do, finish what you start, show up on time, and say please and thank you. I cover those four with my 4-year-old every night, and he can recite them back, which I think it's good advice, because that's how business gets done.
Great.
Definitely echo what those two guys said, and I just have two more words to add to that. Take action. A lot of people come to these events and are new or have been around. I've seen the same faces for a couple of years, and they haven't had the chance or the opportunity to get started. There's so many resources in this room of people who are experienced, who are actually taking action and doing things. So connect with those individuals and then take action.
I would have a couple of recommendations. One is understanding what your strengths are. As Bob mentioned, wearing all the hats could be somewhat difficult, and I think strategic partnerships are underrated. So if you are good at raising capital, find someone who's a good operator and find someone who's a good manager, and maybe develop a strategic partnership and go out about it that way. The second thing is, there's three things. Cody, execution. You got to execute. If you start a trade and you don't close it for some reason that is under your control, or if you do a bait and switch on the trade, that basically kills you from any opportunity of seeing another deal from a particular seller. And lastly, I believe strongly that you just can't go out there and be a bid. There's got to be something unique, unique that you can offer a potential seller, or some type of competitive advantage or some type of strength that you can maybe offer. If you're just going out there to be a bid, you're competing against everybody else. So, we've, with our structure through the nonprofit, and that's just one way of doing it, we've been able to eliminate a lot of competition, and we get loans at slightly under market value on a negotiated trade basis, on a flow basis. Not that it's going to last forever, and we're already working on creating a new niche. But if you can create a niche that you can offer the seller something other value than just a particular price, you'll have good relationships and success.
Outstanding. Before we wrap up, I also wanted to recognize Lewis. Not only is he a sponsor and has his platform, but he is also the media sponsor through Capital Markets Today. I don't know if you guys subscribe to his podcast, but you should. I was on there, Fuquan was on there, Cody was on there. I think Bill's been on there in the past. He does a great job, always doing a little series ahead of NoteExpo with some of the speakers. So we appreciate that and your support there. Fuquan's been a supporter of ours for many years. He has a booth there. Cody as well. Cody's the ice cream guy. He provided all that great ice cream. And Bill
Brought some free books.
Bought some free books. There you go. But we appreciate him. Bill's been here in the past, and I think he had some scheduling conflicts in the last year, but we were able to get him back this year, so we're happy to have him. And again, I enjoy this panel because I like to show the audience that in the industry, everybody thinks it's, backstabbing, cutthroat, competitive, you can't stand each other, and yet, we all get along. We all try to find a way to do a trade. Sometimes it doesn't work. Sometimes it takes a few years to get one that fits our box. But we're always doing it. I've reached out to Fuquan on some New Jersey assets. Some of them didn't work, some of them may, and we just try to work that out. So I always appreciate you guys, and please, let's thank them for being here. Thanks, Liz.